Hello and welcome to the lecture for Chapter 5, Part 1. In this lecture, I'll talk about receivables primarily. And the one thing that we know about receivables, meaning when we sell things to customers on credit, is that not all of them will pay us, that we'll have some bad debts. So how we account for bad debts is really kind of the trickiest part of receivables. So I'll talk about a couple of different methods to do that, and I'll explain kind of an overview of how we handle that, and I'll talk about these specific methods: percent of revenue, percent of receivables, and then aging of receivables, which is the best method, I think. And then the second lecture for this chapter, I'll talk about notes receivable, which is a different type of receivable. I'll talk about how to handle credit card sales. That's pretty straightforward. And then I'll talk about inventory cost flow assumptions. So I'll give you an overview of that and some discrete examples of ways to do that. So first of all, let's look at receivables in general. So the receivables are when people owe the company money. So it's money or cash that we're going to receive in the future. The most common type of receivable is accounts receivable. That happens when we sell product to customers on credit, usually net 30 terms, so they pay within a month for either selling them a product or providing them with a service. So they're very short-term in nature, and they're classified as a current asset. Current assets are assets that we expect to either use up or have them turn into cash within the upcoming 12-month period. So accounts receivable will definitely fall into that. That's a fairly informal kind of an arrangement with a customer, meaning that they give you a purchase order, you provide them with the product, and you send them an invoice. So it's not a contract per se. It's a little looser than that. A note receivable is similar in that it's also somebody is going to pay you money in the future, but it's more formal. So usually it's evidenced by a promissory note, so a written document that details what the payments are to be, the interest rate, collateral, those kinds of things. In my business, I use notes receivable when the sale was a larger amount, or maybe a customer I didn't have as much experience with. I wasn't comfortable necessarily with an informal arrangement with them, so I would draft a promissory note and ask them to sign it. The big difference there is a promissory note or a note receivable puts you in a better position to collect on that from a legal standpoint if you should have to do so in the future. And then there are often other kinds of receivables on a company's books as well. Interest receivable, which is interest that we've earned that we have not received the cash for yet when we loan money to other people. That can arise through a note receivable. Loans to employees, loans to officers in the company, those kinds of things which we would separate out from accounts receivable. As I mentioned, the biggest problem is how to handle uncollectible accounts. So when a customer is granted credit, some of them are not going to pay, either through bad intent, they never intended to pay, or through circumstances beyond their control. People lose jobs or pass away or whatever the case is. So the expense associated with that not getting paid from a receivable is called uncollectible account expense. Some companies call it bad debt expense as well. And the key thing here is we want to match that expense with the period in which we recognize the sale to the best extent possible. We do that by creating an allowance at year-end, an allowance for doubtful accounts that gives us a provision for future write-offs. So if I make 10 sales this year, and each of the sales is $10,000. So at the end of the year, some of those would still be owed to me. I would make a provision that maybe some of those I won't get paid. The net realizable value of our accounts receivable is the total amount that customers owe us less that allowance for doubtful accounts. That's what we ultimately think that we're actually going to receive. Now, all of you will be managers in businesses, and most of those businesses will have receivables, will invoice other companies or individuals with credit terms. And so it's good to know kind of when you're going to have a problem. So the number one indication that you might have a problem is that the receivable is past due. So if it's you invoice somebody on 30-day terms and the 31st day arrives and you haven't seen the payment from them yet, that's the first indication there's a problem. The number one thing you can do to prevent collection problems is to call people on the 31st day. So don't wait until months have gone by before you make your first collection call. Call, and it can be a friendly call. It doesn't have to be negative. It can be, hey, the invoice that we sent you came due yesterday. I was just calling to get a check number from you and what date the check was mailed. That kind of a thing. But contacting them, you might have heard the phrase, the squeaky wheel gets the grease. So if a company has cash flow problems, they're going to pay the people that are calling them. So another problem would be the customer doesn't respond to inquiries. So you call them and they never call you back. That's a potential problem. You may want to visit them in person or something like that, depending upon the dollars involved. Obviously, if the customer files for bankruptcy, that's a problem. So once a customer files for bankruptcy, then the way you're going to collect money from that is through bankruptcy court. So you might get a portion of what they owe you, but you have to stop proceedings against the customer once they've filed for bankruptcy. If the customer closes their business, obviously that's a problem as well. And if you simply can't locate the customer, if they've gone missing, that is also obviously a problem. So here's a graphic to kind of help you think about the allowance method. So at the end of a year, we'll use one of a couple of different methods. One of the methods that they show in the book is the first one they show is the percentage of revenue. So it's a very simple way to do it. You take what your credit sales were during the year and multiply that by a percentage. That might be an industry benchmark. Maybe you know that you work at a law firm and the average for law firms is 5% they have to write off. So use that kind of a percentage, or you may have been in business long enough where you've developed a track record and you can use your own percentage. But at the end of the year, we will make an entry where we recognize bad debt expense or uncollectible account expense based on sales times that percentage. And then we create this allowance for doubtful accounts, a provision that we can use for future write-offs. That way we've recorded the expense and we've created the provision in the year in which we've made the sales. So we have proper matching there. Later, when we actually determine, John Doe isn't going to pay us, he filed for bankruptcy or whatever the case is, and we decide we actually have to write off a receivable that could be in the following year, we don't recognize an expense at that point. We take it out of that allowance that we've created, that provision that we've created for future write-offs. So the allowance method, which is the method that's approved by generally accepted accounting principles, again, requires us to estimate at the end of every year what our potential uncollectible accounts would be. And again, we use what's called a contra account. So that allowance for doubtful accounts, that provision, is going to have the opposite balance of our receivable account. So our receivable account, think of it as being a positive number. The allowance for doubtful accounts would be a negative number to offset that. And it's the contra account that's decreased when a specific receivable is written off. So let's walk through an example here. So a company makes a sale on account, so $100,000 in sales, so retained earnings goes up, accounts receivable goes up. At the end of the year, they'll use one of a couple of different methods. The first two that the book talks about are percent of sales or percent of receivables. So let's just say they used 5% of sales. So in that case, they recognize $5,000 of uncollectible account expense, which pulls down retained earnings, and they create that provision. And you can see there it's a negative number. So in this case, the net realizable value of receivables for this company at that year end is $95,000. That's the amount they ultimately think they'll collect. The next year then, the company decides that a particular receivable is uncollectible and has to be written off based on their judgment. So in that case, they lower their receivable amount. Okay, they have a list of people that owe them $100,000 and they scratch one of them off, right? They say, okay, that one we're not going to get. So they reduce their receivables and they reduce their allowance for doubtful accounts. But again, they reduce a negative number with a positive number, so that way our entry balances there, both sides are zero. Okay, so they had negative 5,000, they adjust that with a positive 1,000, so they end up now with a negative 4,000 allowance. So they now have a provision for future write-offs in the amount of $4,000. So one thing the textbook talks about that doesn't happen in the real world very often is that an amount that you've written off is later collected. You go to the mailbox and lo and behold, there's that $1,000 check. They actually paid you. So what do we do in that case? Well, we need to reverse the prior write-off first. So I need to reestablish that receivable by increasing accounts receivable, and I can reestablish my allowance by bumping it up by another $1,000. Again, that's a negative number. And then we accept the cash as we normally would. We increase our cash account and we decrease accounts receivable. So the first step is reversing the write-off that we did in the past. But notice that does not affect retained earnings. We don't recognize additional income or anything like that. Now the methods for doing that estimation at year end, as I mentioned, the first one, percentage of sales. That's a pretty simplistic way to do it. A lot of companies do it. It's perfectly acceptable. Another method is percent of receivables. So I would look at what is the total amount owed to me at year end and what percentage of that do I think is not going to be collectible. So that's also using past experience or industry averages. It's another way of calculating or making that estimate. The last way I want to talk about is a bit more complicated, but it's also, I think, a bit better. It's the aging of receivables. So I look at my receivables at year end and I look at the health of those receivables and I make my estimate based on how healthy the receivables are. Healthy receivables are all within terms, nothing is past due. Unhealthy receivables would be a lot of them are past due. So I create what's called an aging. So I take the due date of every receivable, okay, and I can do that in Excel or do it manually, and I determine the number of days past due it is. That's going to put it in a category. I'll have receivables that aren't past due, some that are 0 to 30 days past due, some that are 30 to 60 days past due, and so forth. I'll have buckets of receivables based on their health or how past due they are. I'll come up with a total for each category, and then I'll multiply that by a percentage, and I'll use an estimate of that. The assumption is the older something is, the bigger percentage I'll use because it's more likely that I won't get paid if it's much older or more past due. So that'll give me a total that I can add all of those amounts up. That'll give me the total that I need for my allowance for doubtful accounts. And then this is the key difference here. I'm going to look at what the existing balance is, my allowance, and I'm going to make an adjustment to bring it up to the amount that it should be. So I'm going to make an adjustment rather than just booking what the math tells me to. So here's an example where the squiggly lines represent a break in the receivable aging here, where you can see I've got a list of the people that owe me money, and then I've got those buckets or those categories of what is not past due, and then different amounts of days past due, okay, up to over a year past due. And I've got totals for each of those columns that equal the total for all of my receivables, in this case $240,000. And then they have applied some percentages. And it's the kind of thing where companies that use this method have percentages they've used in the past. You can tweak those a little bit depending upon your company's experience with collections. There's not a hard and fast rule. It doesn't have to be 2, 5, 10, 20 as is shown here. It can be whatever makes sense for your business. The key thing is that you don't manipulate it every year just to get the result you want. So, and then we do the math there. So you can see in this case, this company should have an allowance for uncollectible accounts of $26,490. So it's arrived at mathematically, okay? So in this case, if the company, say that last example we used, if they had an allowance for doubtful accounts of $4,000, they would make an adjustment of increasing that $22,490, and that would be their expense for the year, is getting it up to that level. So I hope that makes sense to you, and I will talk to you again when I record the second part of the lecture for this chapter. Thank you.